Real estate at an institutional level functions primarily as a debt game rather than an equity game. The architecture of commercial property returns is predicated on the mathematics of borrowed capital, which serves as a fundamental design feature for equity multiplication. This structural reality has become increasingly confrontational following the shift from a decade of near-zero interest rates to the higher-for-longer regime initiated in 2022. Historically, borrowing at 3% to acquire assets yielding 4.5% provided automatic equity amplification. In the current environment, with the Fed funds rate sustained near 5.25%, the spread between unleveraged net income yields, known as cap rates, and the cost of borrowing has compressed, necessitating a transition from passive wealth building to high-precision debt architecture. The physical inertia of real estate creates a structural moat that protects net operating income, or NOI. Unlike digital assets or manufactured goods, stabilized multifamily assets in premium locations face significant supply friction. Construction costs have risen over 40% since 2019, while permitting timelines in land scarcity restrict new supply. This scarcity supports the replacement cost basis and maintains the NOI floors required to service debt. The market has consequently bifurcated. Assets in supply-constrained markets with durable NOI and conservative loan-to-value structures continue to attract institutional capital, while those reliant on aggressive 75 to 80% LTV financing and optimistic rent growth face a structural reckoning. This environment dictates that the primary risk in 2026 resides not within the physical assets themselves, but within the capital structures positioned on top of them. Precision in deploying leverage is now the definitive requirement for institutional allocators.
The mechanical core of this strategy is net operating income, defined as the difference between gross revenue and operating expenses, excluding debt service. This exclusion isolates the property's intrinsic earning power. Optimization occurs through three levers: rent growth in supply-constrained markets, vacancy minimization, and rigorous expense control. For instance, a 5% occupancy increase on a 250-unit asset at $2,000 monthly rent generates $300,000 in additional annual NOI. At a 5.5% tap rate, this translates to $5.4 million in manufactured asset value. The leverage multiplier amplifies equity yield through a specific mathematical relationship. Consider a $10 million asset with a 6.5% cap rate generating $650,000 in NOI. If an investor deploys $2.5 million in equity and borrows $7.5 million at a 6% interest rate, the annual debt service is $450,000. The residual income to equity is $200,000, resulting in an 8.0% cash-on-cash yield, materially higher than the 6.5% unlevered yield. This is accretive leverage. However, when the cost of debt exceeds the cap rate, the system enters negative leverage, where debt actively destroys equity yield. To mitigate this risk, lenders utilize the debt service coverage ratio, or DSCR. A standard 1.25x DSCR ensures the property generates 25% more income than required for debt payments. Additionally, the debt yield, calculated as NOI divided by the loan balance, serves as an independent stress metric. An institutional threshold typically sits at 10%. If the debt yield falls below 8%, lenders reduce proceeds or increase risk premiums. As of late 2025, the spread between average commercial interest rates and cap rates has compressed to approximately 23 basis points, meaning the free lunch of positive leverage has been replaced by a requirement for organic NOI growth over the hold period.
The leverage multiplier acts as a capital destruction machine when the spread between income and debt costs inverts. Between 2025 and 2026, approximately $1.5 trillion in commercial loans will reach maturity. Many were originated at rates between 3% and 4.5% and must now be refinanced at rates exceeding 7%. This creates a brutal funding gap. For example, a property purchased at a 75% LTV may now only qualify for a 65% LTV loan due to cap rate expansion and stricter underwriting. This forces the investor to fill the gap with fresh equity or face a maturity wall collision. While extend and pretend strategies delay defaults in 2024, data indicates that the era of unlimited extensions is closing, with only 21% of maturities being extended in 2025. To offset these risks, institutional investors utilize a sophisticated tax stack involving depreciation and 1031 exchanges. Standard straight-line depreciation is often replaced by cost segregation studies, which reclassify building components into 5, 7, or 15-year asset categories. Under the One Big Beautiful Bill Act of 2025, 100% bonus depreciation allows for massive front-loaded deductions that shield ordinary income. This is coupled with the 1031 exchange, which allows investors to defer capital gains by swapping into like-kind properties within strict 180-day windows. However, investors must account for operational friction, transaction costs of 3 to 5%, capital expenditure reserves of 10 to 15% of NOI, and management fees. The rational verdict for 2026 is that the leverage multiplier remains a core cash flow anchor, provided it is used with strict quantitative guardrails. Maximum 65% LTV, a minimum 150 basis point positive spread at entry, and a 7-year minimum hold period to absorb market volatility. For those relying on aggressive assumptions, it functions as a capital trap.